Now, while war is terrible for humanity and there's a fair amount of uncertainty, there is life that moves on in investments as well. And I was just looking at some data over the last 3 decades or so. The 6 major wars that we've had, the markets have actually ended positive at the end of those wars on 5 occasions, barring one. So let's see how one should view their investment strategy during these uncertainty or during these periods of uncertainty as well. We have Abhilash Narayan, who's the senior investment strategist at Group Wealth Management at Standard Chartered, joining in. Abhilash, thank you for joining in. Yes, it's a somber period, a fair amount of uncertainty, serious loss of life and wealth as well, and destruction of property. But for those who are looking at this uncertainty as periods of investment, what should the strategy be?
Well, clearly, I mean, what's happened over the weekend is a terrible tragedy with over 1,000 people losing their lives. But I think from an investment perspective, we need to see how this thing evolves. I mean, if history is any guide, such escalations between Israel and Gaza tend to last a few weeks. So we need to see how that pans out. But yeah, in the near term, we think that we could see a risk-off in markets. We are already seeing some signs of that. So global equities could take a pause, especially given the fact that they've had a good run this year. But more importantly, the most clear impact will be on oil prices. So given the fact that oil inventories globally are quite low and there is a risk to supply, that would be the one asset class where we see the most impact.
Okay. All right, Abhilash. Your thoughts in terms of how you would approach the broader markets if in case there is a correction that we see in our markets. How would you approach it in terms of the mid caps as well as the small caps?
Well, within India, we used to be overweight on mid caps and small caps, but just recently we have downgraded them to neutral given the fact that we've seen quite a strong performance come through. And if you think about global economic uncertainty, then generally large cap companies tend to have a more sizable buffer to withstand any slowdown. So right now we are neutral from a size style perspective. We think it makes sense to allocate more towards value oriented sector and manufacturing sector. So we are overweight on financials as well as industrials in India, because we think for the next couple of years, the earnings growth for those sectors should be strong, and they're more oriented towards domestic economy, right? So banking sector balance sheets are quite healthy, and with the infrastructure policies that have been announced over the past few years, that is one sector where, industrials and infrastructure is one area where we continue to expect solid earnings growth going forward.
Okay, in infrastructure and what did you say?
Industrials. So
similar,
yeah.
Okay, okay, got it. So is that largely because of the expectation as we run into the general elections as well, spending picks up? Is that one of the primary reasons? And, we've already seen from a stock perspective, I know you wouldn't want to comment on that, but from a market perspective, right? A lot of these stocks have given great returns already, expecting that perhaps this spending could shape up. What's the best way to approach it now?
Yeah, you're absolutely right? I mean, if you look at Indian equities in general and some particular stocks within these sectors, they've had a good run. Now, when we look at it from a sector perspective, we still expect, over 20% earnings growth for industrial sector. And if you look at, banking sector in general, we think that the credit growth in the sector is expected to be quite solid. The bad loans ratio is quite low. So, and valuations aren't that expensive as well. And if you look at financials specifically, October tends to be quite a good month. So I was looking at data over the last 10 years, and banking sector generally tends to have a positive return in the month of October. So, if Indian equities are to deliver a positive return in this month, a lot will rely on banking sector, given the nearly 30% weight in the broader index.
Mm-hmm. Right. What are your thoughts on a few more global-facing sectors like IT do? Because now we're heading into the result season. TCS has already announced a buyback. Do you think with the underperformance that we've seen over the last 12 to 18 months, the IT stocks are poised for some sort of recovery? Or is there some way, some more downside before we enter?
Well, from a technology and IT sector perspective, I think the outlook varies by different geographies, right? So on one hand, we are overweight on US technology sector because you have a lot of software-focused companies and companies which benefit from the AI-driven investments. But if you look at Indian IT sector, a lot of that is still service-based. So it will depend on how US economy and European economy pans out. We think that growth there will slow down. So we could still see a bit more challenging outlook for Indian IT sector in the near term, especially for the companies which derive majority of their revenue from US and Europe.
Okay. Abhilash, just coming back to the larger ramifications of this conflict which is taking place, do you think that there could be any kind of fallout on global growth? Because we're already dealing with a Fed which might be higher for longer. We're already dealing with the Russia-Ukraine war which has gone on for around 593 days. Now with this, do you think that that could probably weigh on global growth? Is that something that your economists or your equity team is probably looking at?
Well, it's certainly a bit too early to comment on that. A lot will depend on how the whole conflict and the escalation evolves over the next few days. But it's certainly a risk to watch out for because, let's say this escalates and Israel and Iran get caught in a more direct conflict, then yes, it could end up impacting global growth. And the most direct impact channel will be oil prices because higher oil prices are effectively an additional tax on the consumer. So, if oil prices hypothetically were to go to $150 per barrel, which is not a base case, but let's assume it happens, then obviously it will end up leaving less money in the pockets of consumers to spend on other stuff. So yes, if this escalates, then higher oil prices will be the main channel of transmission of impact to slower global growth. But let's wait and watch how this whole thing evolves over the next few days.
All right, we'll leave it at that. Thanks a lot, Abhilash, for joining in and giving us a quick take on what the monetary, the economic implications could be of the war situation. Never goes well, really. But let's see, hopefully peace prevails and we won't have to deal with a grave situation on our hands. Let's slip into a quick break. On the other side.